In light of the heightened uncertainties abroad and a slightly softer expected path for inflation, the committee judged it appropriate to wait for more evidence, including some further improvement in the labor market, to bolster its confidence that inflation will rise to 2% in the medium term.
The Federal Reserve Committee has 2 remaining meetings this year when it could possibly raise rates. Let's turn now to CNN's Andrew Stevens in Hong Kong. He's gauging how markets there are responding to news about the US Fed decision. Andrew, this could have been the first rate rise in the US in nearly a decade. It didn't happen, not a great surprise. So how did the markets react?
Yeah, you have to go back to 2006 to see the last interest rate rise. I think the best way to describe the reaction is confusion, Lynda. It's just not clear still what the state of the global economy is, what the state of the US economy is, even though Janet Yellen was clearly saying that there has been a slowdown in the global economic outlook, led, of course, by China, a rather abrupt slowdown in China. What the impact of that is going to be on the US economy, the Fed prefers to wait and see rather than pulling the trigger on interest rates at the moment. And if you see how the Dow reacted overnight to the news, it was up and down as traders tried to digest the news and make a sense of what it meant for stocks. And take a look at the Asian markets as well. You'll see there the Dow finishing down about 0.4%. And if you look at the Asian markets today, they're sort of, well, they're up at the moment, but they've been in and out of positive territory. You see the Nikkei now down by nearly 1.5%. So, Lynda, there is still this sense of confusion. Where are we and what happens next? Because when the Fed does pull the trigger on interest rates, it will just be the beginning. And that starts the interest rate cycle. At least that's what people are saying, where you get back to a normal situation. But as yet, we're still in these abnormal times with interest rates at virtually zero.
That's right. And as you mentioned, the Fed no doubt worried about the global outlook, particularly China's slowdown, Japan's growth stalling, and even Australia, the commodities boom is no longer. What sort of impact did the Fed decision have on the currencies there?
Well, the Fed has been having an impact on the currencies for a long time, all related to interest rates. You need to go back to the taper tantrum, as it was known. That was when the then Federal Reserve Chief Ben Bernanke started easing back on that QE, that massive stimulus, which was all aimed at leading up to the first interest rate cut. And that is when emerging market currencies started reacting to expectations of a rate rise. And if you look at what the emerging market currencies have done since that decision by Bernanke, that was back in May of 2013, you can see there have been massive falls for a lot of those key emerging market currencies. Look at the real in Brazil, down 87% against the US dollar, the rupiah down 50%, because the expectation is when rates go up in the US, a lot of money will switch into more attractive assets out of these emerging market economies. In fact, Brazil is now in recession, so it's already a work in process how the interest rates or interest rate expectations are hurting these emerging markets. When they actually do raise rates, it's probably going to have the impact of deepening those losses.
That's true, and it may happen later this year, but a lot of analysts are saying it's more likely next year. So we'll just have to wait and see. Andrew Stevens in Hong Kong, thank you very much.